$500 billion poured into U.S. stock funds this year, with half of that, an astonishing $250 billion, in the fourth quarter alone. Yeah, share investors bought stocks based on Jay Powell cutting rates. It's one reason why the share market went parabolic after August, or at least parts of it did. A blow off top? The numbers are becoming increasingly hard to ignore. Now, share prices always go up. It's what they do. It's when they don't that you need to pay attention. It's not just that stocks are overvalued and most investors are demonstrably complacent. They're doing so for all the wrong reasons, like Jay Powell's proficiency. The major share indexes have gained 20% for the second straight year, something that hasn't been done since 97 and 98, and we're already into troubling numbers. The warning signs are piling up. The equity risk premium has utterly collapsed, a sign of overstretched valuations and complacency. $250 billion of complacency at the very least. Forward price to sales on the biggest top bubble names, those have equaled dot-com highs. And despite the persistence of the AI bubble, and we all know it is a bubble, there continue to be major divergences all throughout the markets. Something had kept equity investors out of these specific stocks in parts of the marketplace for almost 5 months now. Looking at you, Philadelphia and the Sox. And that's a big one that you would think would be all in on the AI euphoria. No matter what the S&P 500 or NASDAQ has done during these 5 months, those markets aren't signing up for semiconductors. Is there too much focus on AI? Even the ECB came out with a report that said, hey, we need to be very careful about what's going on in the AI arena over there in the United States. As I said, share prices go up. It's what they do. There are only a small number of circumstances when they don't. So if you start to see divergences among major indexes or classes of equities, you have to start paying attention to those. And the AI bubble itself has been a key counter-cyclical force in the global economy. So when it busts, inevitably, it's going to hurt, whenever that might be. Well, where we start from is that there is a stock market bubble happening right now. We can see it in all the big numbers, including the annual returns this year. As the Wall Street Journal reported today, U.S. stocks roared to another blockbuster showing in 2024, and few expect such a torrid advance in the year to come. The S&P 500 has climbed 24%, notching 57 record closes. Even with a stumble in the last few trading days, the broad U.S. stock index is on pace for its best consecutive years since 97 and 98, at least according to Dow Jones market data, during the lead up to the bursting of the dot-com bubble. And few people had expected it this year. People were thinking that the stock market would take a year off after such a resurgence in 2023. But that's the thing about stocks. They continue to go up until they don't. Now, a lot of people are expecting it to repeat this year because of all of the Goldilocks scenarios that are supposedly in every facet and every corner. According to the New York Times, on average, analysts are forecasting that the S&P 500 will rise around 10% in 2025, half the rate of the last couple of years, but still a substantial return on top of those 2 big years. And that includes analysts at Morgan Stanley and JP Morgan Chase, who until recently were bracing for a downturn. They've all shifted, which is not a good sign. The chief investment strategist at brokerage firm Oppenheimer heads into the new year as the most bullish on Wall Street, anticipating a 2025 gain of close to 20%, which would be obviously the 3rd straight one. Stock indexes continue to be buoyed by multinational tech giants like Apple, Microsoft, and Nvidia, with investor exuberance for artificial intelligence pushing up prices of those already richly valued stocks, which have a big influence on the market because of their size. And this month, Broadcom, another chip maker, became the latest company to achieve a $1 trillion valuation. The tech-heavy NASDAQ composite is poised for a gain of more than 30% this year, greatly outpacing indexes like the Russell 2000, which tracks smaller companies more linked to the ebb and flow of the domestic economy. And already you're starting to get a warning sign. The Russell index is set to rise about 10% this year, far lagging behind all the rest, because despite all the euphoria over the AI and the Fed's rate cuts, there's a reason why the Fed's cutting rates, and it's in the fact that the Russell 2000 can't get much of a bid. But the big one, though, that really puts the numbers on this bubbly type of behavior Getting back to the New York Times, in 2024, roughly $500 billion flowed into funds that buy U.S. stocks. More than half of that came in the fourth quarter, after the Fed had begun to cut rates, with the two biggest weeks coming after Election Day, November, and then the most recent Fed rate cut in December. So the risk here is all of that complacency and euphoria placed on the Federal Reserve, oh boy, and the incoming Trump administration the ability of the administration to deliver on its promises relatively quickly, setting up a whole bunch of really high expectations that are not likely to be met, therefore risking a dramatic reversal like we see in every bubble process. And bubbles, after they reach these proportions, the chances of their bursting go up that much further. At least one place where expectations can be met, that's at Eurodollar University. We're in the final 2 days of our Christmas New Year's sale. Here's your chance to go deep into the money and macro world. I recently went over everything we talked about here in greater detail in our deep dive analysis. And we've got a special price on the DDA where you get that plus Eurodollar University AI, a membership, as well as a daily briefing, all for one exceptionally low price. Like I said, tomorrow's the last day, and we're probably not going to offer this price again for maybe another year. So here's your last chance to get on Eurodollar University, the DDA. If you're interested in just a membership or a subscription to the daily briefing, those are available too. All the information at eurodollar.university. Now, central banks by nature are relatively careful and cautious, especially where it comes to stock markets, given the historical significance, even though there's no historical relationship between share markets and monetary systems these days, and it hasn't been since the 1930s. Even so, central banks are well aware of the possibility of stock prices to get into asset bubble type of territory. And the ECB, about a month ago, came out in its financial stability review with some pretty sobering warnings on the U.S. stock market, including even more sobering calculations where it comes to the equity risk premium, which I'll get to in a moment. What the ECB wrote was, there are signs that investors may be underestimating and underpricing the likelihood and impact of adverse scenarios, as indicated by record low equity risk premia and relatively compressed corporate bond spreads on both sides of the Atlantic. Also, concentration of equity market capitalization and earnings among a handful of single names, notably in the United States, has increased greatly in recent years. This concentration among a few large firms raises concerns over the possibility of an AI-related asset price bubble. When even the central bankers are warning about a price bubble, you know it's getting to be serious. The numbers are becoming more and more undeniable. Back to the ECB, also in a context of deeply integrated global equity markets, it points to the risk of adverse global spillovers like we saw in August, should earnings expectations for these firms be disappointed. As such, there's greater likelihood that negative surprises, including sharply deteriorating economic growth prospects, which they would know about in Europe, sudden changes in monetary policy expectations, given how much buying in the United States was done on the expectation that rate cuts were going to be somehow helpful for the first time ever. Because in the stock market, the beauty contest, it's all about sentiment. You never really know when it'll happen. What we know is that as these numbers get bigger and bigger and bigger, and more astonishing, the harder they become to ignore, the likelihood of that turnaround goes up and up and up. And when you marry that sentiment price for perfection with a whole lot of imperfection that we see across the system, especially in, global economic conditions, currency crisis, even just other parts of the stock market, which I'll get to here in a moment, all of it adds up to lots of risks that are not being appreciated by markets that increasingly priced for everything on one thing, in this case, the AI bubble, to hopefully deliver. The equity risk premium, according to the ECB, is calculated as the 5-year cyclically adjusted PE yield for the Euro stocks or the S&P 500 in the US, minus the 5-year real government bond yield, which is the Treasury minus the inflation swap adjusted rate. So when you do that, you see what the ECB puts up here. The equity risk premium in the US market is astonishingly low. A huge amount of complacency, especially when you put it together with ultra low corporate bond spreads. Neither the equity market nor the junk market is expecting anything bad anywhere to ever happen. It's priced to absolute perfection. except the imperfections, as I just said, are getting bigger and harder to ignore too. So you put those two things together. You've got equity markets that are almost record amounts of complacent and a whole lot of things to be concerned about that stock markets are not concerned about. And among those big numbers, here's an article by the Motley Fool earlier this month. The final reason the AI bubble will burst in 2025 has to do with the historically unsustainable valuation premiums that are currently being assigned to market-leading artificial intelligence stocks. Over the last 30 years, businesses on the leading edge of next big thing innovations have often topped out at multiple of 30 to 40 times trailing 12-month sales. This is where Amazon and Cisco Systems peaked before the dot-com bubble burst. In 2024, we've witnessed NVIDIA top a price-to-sales ratio of more than 40, while Palantir Technologies is currently pushing a PS ratio of almost 69. Although it's impossible to predict when investor euphoria will fade, history has been crystal clear that extended valuations of this magnitude are not sustainable over the long run. And that's because as good as those ideas are, and as valuable as the technologies become, it attracts so much other noise. I mean, Amazon had a massive run in 1999, and then it lost about 90% of its value afterward. That's the thing. Even Amazon, which came to rule the e-commerce space, had a tremendous burst with everything else. Because when a new disruptive technology comes on board or starts to people become aware of it, you can assign any valuation. You have no idea who the winners and losers are going to be. And there's going to be a vast majority more of losers than winners. Until the technology becomes fully adapted and settled and matures, it's all just a crapshoot. And so everybody can see that there's going to be value, but you have no idea where that value is ultimately going to land. And the more people are convinced that they've got it right and that there is value, the more it just sucks in more people to the same thing. And so these bubbles become self-feeding. The more tantalizing the technology, the more it is to rationalize that you've picked the exact winners and losers. Or in this case, it's easy. NVIDIA or Broadcom, they're going to be the winners, so just pile into both of those. When in fact, there's a whole lot more that goes into it. And the bigger these numbers become and the more complacent investors get, the closer you know it is to the end, even if you can never predict the exact moment in which it all turns around. The probabilities are now decisively not in your favor. And I've talked about these stock market divergences that we've seen develop really over the last 5 months because they're an important signal that not all parts of the marketplace are buying into the AI bubble or the fact that there's nothing to worry about. The biggest one is the Philadelphia Semiconductor Index, because that is highly cyclical sensitive, meaning that it is the one place in which share investors are actually focused on economic fundamentals because the semiconductor business is itself highly cyclical. Therefore, the perceptions of conditions in that part of the business, that part of the economy, influence share price behavior at these specific moments in time. Because up until August, the Philadelphia Semiconductor Index, the SOX index, had been perfectly correlated or near perfectly correlated, as much as any dynamic marketplace can be, with the S&P 500. They were both in very close lockstep fashion. It was only around July and really August, after the rebound following the carry trade reversal, that the SOX eventually diverged with the S&P 500. The S&P 500, all that share price money piled into the investment funds, and the S&P 500 index, like the NASDAQ and the Dow Jones Industrial Average, they all soared toward record highs. Meanwhile, the cyclical sensitive semiconductor index instead followed the Nikkei over in Japan. There's a very close correlation with those two, contrary to the S&P 500. So while everybody in the S&P 500 was betting on Jay Powell and his rate cuts and then the Trump effect of the presidential election, the semiconductor index through all of it has remained divergent. And that's not the only one. We see other divergences too, including an important one between France and Germany in Europe. The French CAC or CAC index, That one has been lower since the middle part of May, even before the ECB started cutting rates, whereas the German DAX is closely corresponding now with the S&P 500, drawing in all of that complacent bubble-heavy money, whereas maybe the French index is more economically sensitive like the SOX. So like I said, share prices they go up. That's what they do. Everybody puts their money in stocks, at least everybody in the Western world, the United States in particular. That's where Americans leave their savings. So stock prices, they go up. There's absolutely nothing useful about share prices going up as far as information. It's only when you see that indexes or parts of the marketplace stop going up that you should pay attention. Say, what is going on here? With these key divergences that are persisting, despite all of the purported favorable conditions for stocks and the economy and everything else. And then you put that together with these mind-boggling numbers about the share market, the comparisons to the dot-com bust in particular. It's a lot that says pay attention to what's happening in the equity market, because if the AI bubble does bust, not only does that add more of a signal to the negatives that we already see in the semiconductor index, there's going to be a tremendous amount of real world and real economy pain when it inevitably does. And it's with so many warning signs in the real economy anyway, that's more pain than the real economy can really handle at this moment in time. So normally stock prices don't really tell you all that much, except for the fact that people are putting their savings in it. But this is one of those times where the stock market might have a lot to say. Key global cyclical signals, that's the auto business, unfortunately. And what does the auto business have to say? That's what we went over in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's Christmas, New Year's sale. Huge thank you, Eurodollar University members and subscribers. And until next time, Happy New Year.